Welcome to Tax Secrets of the Rich. Save Thousands Legally, written and published by Tony Creed. This audiobook is not financial advice. It's rather a guide to understanding and reshaping your relationship with money through insights and strategies. Taxes are a reality for everyone, but how you approach them can make all the difference. The wealthy don't see taxes as just another bill. They see them as an opportunity. By using the tools and strategies available to anyone, they legally minimize their tax burden, keeping more of their money to invest, grow, and enjoy. The good news? These strategies aren't reserved for the rich. With the right knowledge and action plan, you too can unlock these powerful tax-saving methods and transform your financial future. Imagine being able to save thousands of dollars each year just by understanding how to use the tax system to your advantage. This audiobook will show you how. Whether you're a salaried employee, a small business owner, or an investor, you'll learn actionable steps to legally reduce your taxes while staying compliant with the law. These are not shortcuts. They're smart, ethical strategies that empower you to take control of your finances. Let me share the story of Marcus, a graphic designer who turned his financial life around by embracing tax-saving strategies. Marcus worked hard, but every tax season, he felt like he was losing a significant chunk of his income. He thought there was nothing he could do, until he decided to educate himself about the tax code. Marcus learned how to take advantage of deductions he had been overlooking, like his home office expenses and the equipment he used for freelance projects. He started contributing to a retirement account to lower his taxable income and discovered the benefits of a health savings account for medical expenses. Within 1 year, Marcus saved over $8,000, money he reinvested into his business and savings. Today, Marcus is on track to reach his financial goals years ahead of schedule, all because he took the time to learn and apply these strategies. This audiobook is designed to do the same for you. Each chapter will break down a different aspect of tax planning, from the basics of deductions and credits to advanced techniques for business owners and investors. You'll learn how to leverage tax-advantaged accounts, identify commonly missed opportunities, and create a personalized plan that aligns with your financial goals. By the end of this audiobook, you'll have the tools and confidence to make tax season something to look forward to rather than dread. Taxes may seem complex, but with the right mindset and approach, they become manageable and even empowering. This journey isn't about avoiding taxes. It's about ensuring that you're only paying what you truly owe while making the most of every opportunity to save. It's about taking control of your finances so you can direct your hard-earned money toward the things that matter most to you. Your financial situation doesn't have to dictate your tax strategy. Whether you're just starting out or already building wealth, the principles in this audiobook are designed to work for everyone. You don't need a team of accountants or a high income to start saving. You just need to take the first step. So let's dive in. Together, we'll uncover the secrets the wealthy use to legally save thousands on taxes and show you how to apply them to your own life. The knowledge you gain here has the potential to not only change how you view taxes but also transform your financial future. Your journey to smarter, more efficient finances starts now. Let's begin. Chapter 1. Why Taxes Matter. The Wealth Builder's Perspective. When you hear the word taxes, what's your first thought? For most people, it's stress, confusion, or frustration, an unavoidable burden that takes away a significant portion of their income. But for the wealthy, taxes represent something entirely different, an opportunity. The rich don't see taxes as a rigid, immovable cost. Instead, they view them as a controllable expense, one that can be managed, reduced, and optimized to build greater wealth. This shift in perspective is at the heart of how the wealthy approach their finances, and it's a mindset you can adopt too. Understanding how taxes fit into your financial picture is essential for building and preserving wealth. Taxes are likely one of your largest expenses, but unlike other costs, they come with a set of rules and opportunities that allow you to legally reduce them. By learning how to navigate these rules, you gain the ability to redirect money that would have gone to taxes into savings, investments, or business growth. This doesn't mean avoiding your tax obligations, it means taking control of them. The key to adopting this mindset is seeing taxes not as a punishment but as a puzzle to solve. The wealthy don't accept their tax bill at face value. They ask questions, explore options, and make strategic decisions that allow them to minimize their liability. This proactive approach starts with understanding the tax system, knowing what's possible, and implementing a plan that works for their unique financial situation. Take the story of Priya, a small business owner who completely transformed her financial outlook by rethinking her approach to taxes. For years, Priya had been paying high taxes on her business income, assuming that it was simply the cost of success. But after attending a workshop on tax planning, she realized she was missing opportunities to save. Priya restructured her business as an S corporation, which allowed her to split her income between salary and dividends, significantly lowering her tax rate. She also started tracking her business expenses more carefully, writing off equipment, travel, and even part of her home office. The result? Priya saved over $15,000 in taxes in her first year alone. She reinvested those savings into marketing and new equipment, which helped her grow her business and increase her profits. Priya's story shows how viewing taxes as a controllable expense can create a ripple effect of financial growth. The tax efficiency formula is a simple yet powerful framework for balancing tax savings with long-term financial goals. It starts with three key elements: understanding, planning, and execution. First, understanding. This means learning how taxes work, including how different types of income are taxed, what deductions and credits you're eligible for, and how to use tax-advantaged accounts to your benefit. Knowledge is the foundation of tax efficiency, and the more you know, the better equipped you'll be to make informed decisions. Next comes planning. Tax savings don't happen by accident, they require intentional actions and a proactive approach. This might involve contributing to a retirement account to lower your taxable income, timing the sale of an investment to minimize capital gains, or structuring your business to take advantage of tax benefits. The goal is to create a customized plan that aligns with your financial goals and maximizes the opportunities available to you. Finally, execution. This is where the plan comes to life. It's about implementing your strategy consistently, keeping detailed records, and staying organized throughout the year. Many people make the mistake of thinking about taxes only when filing their return, but tax efficiency is a year-round effort. By staying on top of your finances and making adjustments as needed, you can ensure that your plan remains effective. The tax efficiency formula is not just about saving money, it's about creating financial freedom. Every dollar you save on taxes is a dollar you can use to build wealth, whether that means investing in the stock market, growing your business, or creating an emergency fund. By managing your taxes strategically, you take control of one of your largest expenses and turn it into a tool for achieving your goals. Taxes are often seen as a roadblock, but they don't have to be. When you adopt the mindset of the wealthy and view taxes as an opportunity, you open the door to new possibilities. With the right knowledge, planning, and execution, you can reduce your tax burden, keep more of your money, and accelerate your path to financial success. Let's dive deeper into the strategies that make this possible in the chapters ahead. If you're enjoying this audiobook so far, please hit the like button and subscribe to my channel for more insightful content. Also, don't forget to check the video description for some valuable tools and resources to help you on your wealth journey. Now let's get back to it. Chapter 2. Mastering the Basics. Understanding how taxes work. Understanding how taxes work is the foundation of building an effective tax strategy. Without a clear grasp of the basics, it's easy to feel overwhelmed or assume there's nothing you can do to reduce your tax burden. The truth is, by breaking down the core principles of taxation and learning how different types of income are treated, you can take control of your financial future and make smarter decisions. This chapter will demystify the tax system, explain the differences between income types, and introduce a powerful technique called income layering that the wealthy use to minimize their tax liability. The first concept to understand is how taxes are structured in a progressive system. In a progressive tax system, the more you earn, the higher the percentage of income you pay in taxes. However, this doesn't mean your entire income is taxed at the highest rate. Instead, your income is divided into brackets, and each bracket is taxed at a different rate. For example, if you earn $80,000 and fall into a 22% tax bracket, only the portion of your income above the lower threshold of that bracket is taxed at 22%. The rest is taxed at lower rates. This is where the concept of marginal tax rate comes into play. It represents the rate applied to your next dollar of income, not your entire income. Understanding your effective tax rate is equally important. This is the actual percentage of your total income that you pay in taxes after accounting for deductions, credits, and varying tax brackets. Your effective tax rate is almost always lower than your marginal tax rate, which is why calculating it can give you a clearer picture of your tax burden. Now let's explore the differences between earned, passive, and investment income, as they are taxed differently and offer unique opportunities for optimization. Earned income comes from wages, salaries, or self-employment and is typically taxed at the highest rates because it's subject to both income tax and payroll taxes. Passive income, on the other hand, comes from activities like rental properties or royalties. It often benefits from certain deductions and is not subject to payroll taxes. Investment income includes capital gains, dividends, and interest. Long-term capital gains, for example, are taxed at lower rates than earned income, making them a key focus for wealth builders. One of the biggest mistakes people make is treating all income the same, but categorizing income strategically can lead to significant tax savings. This is where income layering comes into play. Income layering involves deliberately diversifying your income streams to take advantage of lower tax rates and benefits associated with different types of income. For example, you might combine earned income with long-term investments that generate lower taxed capital gains, or you could use rental income to offset earned income through depreciation deductions. The goal is to reduce your overall tax liability by balancing high-taxed and low-taxed income streams. Tax myths can create confusion and prevent people from optimizing their finances. One common myth is that earning more money always means paying significantly more in taxes. In reality, thanks to deductions, credits, and tax planning, many high earners pay a lower effective tax rate than middle-income individuals. Another myth is that tax planning is only for the wealthy or businesses. The truth is, anyone can benefit from understanding the tax system and implementing strategies to save. To illustrate these concepts, let's look at the story of Alex, a teacher who thought tax planning wasn't relevant to his modest income. After learning about tax brackets and effective tax rates, Alex realized he could reduce his liability by contributing to a traditional retirement account, lowering his taxable income. He also began investing in a taxable brokerage account, holding his investments for more than a year to qualify for long-term capital gains rates. By layering his income and taking advantage of these strategies, Alex saved thousands of dollars over time, money he used to pay down debt and build an emergency fund. Understanding the basics of taxation isn't just about knowing how much you owe, it's about empowering yourself to make informed decisions. By learning how progressive taxation works, categorizing your income strategically, and debunking common myths, you gain the tools to take control of your financial future. Income layering is one of many strategies you'll discover in this audiobook, and it's just the beginning of your journey to saving thousands legally. Let's dive deeper into how you can apply these principles to your own life in the chapters ahead. Chapter 3. The Power of Tax-Advantaged Accounts. One of the most effective ways to save thousands on taxes is by leveraging tax-advantaged accounts. These accounts are designed to incentivize saving and investing, offering significant tax benefits that can lower your liability, increase your wealth, and accelerate your financial goals. Whether it's preparing for retirement, managing healthcare costs, or building long-term investments, tax-advantaged accounts play a crucial role in reducing taxes and growing your money. Retirement accounts like 401ks, traditional IRAs, and Roth IRAs are some of the most powerful tools available. A 401k allows you to contribute pre-tax dollars, meaning the amount you contribute is deducted from your taxable income for the year. For example, if you earn $70,000 annually and contribute $15,000 to your 401k, you'll only be taxed on $55,000. These contributions also grow tax-deferred, meaning you won't pay taxes on your earnings until you withdraw the funds in retirement, when you may be in a lower tax bracket. Traditional IRAs work similarly, offering tax-deductible contributions and tax-deferred growth. Roth IRAs, on the other hand, provide a different kind of benefit. Contributions to a Roth IRA are made with after-tax dollars, but your money grows tax-free, and withdrawals in retirement are also tax-free. This makes Roth accounts particularly valuable for those who anticipate being in a higher tax bracket in the future. Both types of IRAs allow for catch-up contributions if you're over 50, giving you even more opportunities to save. One of the most underutilized tax-advantaged accounts is the Health Savings Account, also known as an HSA. Often called triple tax-advantaged, HSAs provide three distinct benefits. Contributions are tax-deductible, the money grows tax-free, and withdrawals are tax-free when used for qualified medical expenses. Unlike flexible spending accounts, HSAs allow your funds to roll over year after year, and many accounts even offer investment options, turning your HSA into a powerful long-term savings tool. If you're enrolled in a high-deductible health plan, maximizing your HSA contributions can significantly reduce your taxable income and help you save for healthcare costs now and in the future. Let's look at the story of Andrea, a mid-level professional who used retirement contributions to dramatically lower her taxable income and build wealth. Andrea was earning $90,000 annually but felt like she was paying an outsized amount in taxes. After consulting with a financial advisor, she decided to maximize her 401k contributions, hitting the annual limit of $22,500. This reduced her taxable income to $67,500, saving her several $1,000s in taxes that year. Andrea also opened an HSA and contributed the maximum amount, further lowering her taxable income while creating a fund for future medical expenses. Over time, these contributions grew significantly through compound interest, putting Andrea on a clear path to financial independence. The maximize and match system is a simple yet powerful strategy to ensure you're fully utilizing employer matching programs and account contribution limits. Many employers offer a matching contribution to your 401k, often up to a certain percentage of your salary. For example, if your employer matches up to 5% and you earn $60,000, contributing $3,000 to your 401k will result in an additional $3,000 from your employer, essentially free money. Failing to take full advantage of this match is like leaving money on the table. Your first priority should always be to contribute enough to receive the full employer match. Once you've maximized your employer match, focus on increasing your contributions to reach the annual limit. Automating your contributions makes this process effortless and ensures you stay consistent. If you have additional funds to invest after maxing out your 401k, consider contributing to a traditional or Roth IRA. For those with high deductible health plans, HSAs should also be a top priority. Beyond retirement and health accounts, other tax-advantaged options include 529 plans for education savings and self-employed retirement plans like SEP IRAs or solo 401ks. These accounts provide additional opportunities to reduce your taxable income while saving for specific goals. If you're self-employed, taking advantage of these plans can significantly lower your tax liability and boost your savings rate. One of the key benefits of tax-advantaged accounts is the compounding effect of tax-free growth. Every dollar saved on taxes and reinvested has the potential to grow exponentially over time. For example, a $5,000 annual contribution to a 401k growing at 7% annually can grow to over $500,000 in 30 years. By starting early and contributing consistently, you can maximize the long-term benefits of these accounts. Another important aspect of tax-advantaged accounts is their ability to provide flexibility in retirement. By having a mix of traditional and Roth accounts, you can strategically withdraw funds to minimize your tax burden in retirement. For instance, you might withdraw from a traditional 401k up to the level of your standard deduction while using Roth withdrawals for additional income, effectively keeping your taxable income low. While these accounts offer significant benefits, it's essential to stay informed about contribution limits, eligibility requirements, and potential penalties for early withdrawals. Working with a financial advisor or tax professional can help you navigate these details and ensure you're maximizing your opportunities. Tax-advantaged accounts are more than just a way to save, they're a cornerstone of a smart financial strategy. By understanding how to use retirement accounts, HSAs, and other options effectively, you can reduce your tax liability, grow your wealth, and achieve your financial goals faster. The Maximize and Match system ensures you're not leaving any opportunities on the table, while the power of compounding turns today's savings into tomorrow's security. Let's continue exploring how you can unlock more tax-saving potential in the chapters ahead. Chapter 4. Tax Deductions. What you're probably missing. Tax deductions are one of the most powerful tools for reducing your tax burden, yet they're often misunderstood or overlooked. While the tax code may seem complex, it's actually designed to reward taxpayers who understand how to take advantage of these opportunities. By identifying and claiming the right deductions, you can significantly lower your taxable income and keep more of your hard-earned money. This chapter will explore commonly missed deductions, show you how the wealthy maximize their savings by tracking expenses year-round, and introduce the deduction tracker system to ensure no opportunity slips through the cracks. Let's start with one of the most overlooked deductions: home office expenses. If you work from home, even part-time, you may qualify for deductions on a portion of your rent or mortgage, utilities, internet, and other home-related expenses. The key is to use a space exclusively for work. For example, if you dedicate 10% of your home's square footage to a home office, you can deduct 10% of eligible home expenses. This deduction is especially valuable for freelancers, remote workers, and small business owners. Education-related costs are another area where taxpayers often miss out. While most people know about deductions for tuition or student loan interest, fewer are aware of the potential to deduct job-related education expenses. For example, if you take a course to improve your skills or maintain a professional certification, those costs may be deductible. This includes tuition, books, supplies, and even transportation to and from class. Charitable contributions are one of the most well-known deductions, but many taxpayers fail to maximize their impact. Beyond cash donations, you can deduct the value of goods donated to charity, like clothing, furniture, or even a used car. Additionally, any expenses incurred while volunteering, such as mileage or supplies, can be deductible. The key is keeping detailed records and ensuring the organization you're donating to is qualified. The secret to the rich maximizing their deductions is in their year-round tracking habits. They don't wait until tax season to think about their expenses, they document everything as it happens. This approach ensures they capture every eligible deduction, no matter how small. Small expenses, like subscriptions, travel costs, or professional development materials, can add up over time and significantly reduce taxable income when properly documented. Consider the story of Mia, a freelance writer who transformed her tax situation by becoming diligent about tracking expenses. Mia initially struggled to manage her finances, often scrambling at the end of the year to piece together receipts. She realized she was missing valuable deductions, like software subscriptions, internet bills, and the mileage she accrued while meeting clients. Determined to improve, Mia started using a tracking system to log every business-related expense. By the following year, she had doubled her deductions and saved thousands of dollars in taxes. The savings allowed her to invest in better equipment and grow her business. The deduction tracker system is a simple yet effective way to ensure you never miss a deduction. It starts with setting up a dedicated account or credit card for expenses related to work or specific activities, making it easy to separate deductible costs from personal spending. Next, use an app or software to log your expenses in real time. Tools like QuickBooks, Expensify, or even a spreadsheet can help you categorize and track deductions. For mileage, use apps designed to automatically log trips, ensuring you capture every eligible mile. Another component of the deduction tracker system is staying organized with receipts and documentation. Many taxpayers lose deductions because they don't have the necessary records to back them up. Snap photos of receipts immediately after purchases and store them digitally in folders categorized by expense type. Keeping a calendar of work-related events, such as conferences or client meetings, can also help you track associated costs. It's important to note that tax deductions must be legitimate and accurately reported. While it's tempting to push boundaries, misreporting expenses can lead to audits or penalties. The goal is to maximize your deductions while staying within the boundaries of the law. Consulting with a tax professional can help you ensure compliance and uncover additional opportunities you might have overlooked. Tax laws and deductions evolve over time, so staying informed is key. For example, new deductions or credits may be introduced for energy-efficient home improvements, healthcare costs, or disaster-related expenses. Reviewing changes to the tax code annually can help you identify new ways to save. Deductions are not just about saving money. They're about taking advantage of opportunities built into the tax system to reward specific behaviors, like investing in your career, donating to charity, or growing a business. Every dollar deducted is a dollar that stays in your pocket, giving you more freedom to reinvest in your goals. By adopting a proactive approach and using the deduction tracker system, you can ensure you're capturing every eligible expense and maximizing your savings. The key is consistency, organization, and a commitment to documenting your finances year-round. Let's continue exploring how to unlock even more tax-saving potential in the chapters ahead. If you're enjoying this audiobook so far, please hit the like button and subscribe to my channel for more insightful content. Also, don't forget to check the video description for some valuable tools and resources to help you on your wealth journey. Now let's get back to it. Chapter 5. Tax Credits. The Secret Weapon of the Wealthy. Tax credits are one of the most powerful tools in the tax system, yet they're often underutilized or misunderstood. While deductions reduce the amount of income you're taxed on, credits directly reduce the taxes you owe. In other words, a credit is a dollar-for-dollar reduction of your tax bill, making it far more impactful than a deduction of the same amount. For the wealthy, tax credits are a secret weapon, enabling them to significantly lower their tax liability while aligning their actions with the incentives built into the tax code. Understanding the distinction between deductions and credits is crucial to maximizing your savings. Imagine you're in the 22% tax bracket. A $1,000 deduction would save you $220 in taxes. But a $1,000 credit would reduce your tax bill by the full $1,000, regardless of your tax bracket. This is why credits are so valuable. They provide direct savings without being subject to the limitations of marginal tax rates. Some tax credits are refundable, meaning they not only reduce your tax bill but can also result in a refund if the credit exceeds the taxes you owe. For example, the Earned Income Tax Credit, also known as EITC, is a refundable credit designed to support low to moderate income earners. This credit can provide thousands of dollars in relief, making a substantial difference for qualifying families. Even if your tax bill is zero, a refundable credit can still put money back in your pocket. Another category of high-impact credits focuses on energy efficiency. The government offers incentives to encourage homeowners to invest in renewable energy and energy-efficient upgrades. For example, the Residential Clean Energy Credit allows you to claim 30% of the cost of installing solar panels on your home. This credit applies not just to the panels but also to related expenses like inverters and labor. These initiatives not only reduce your tax bill but also contribute to long-term savings on energy costs. Let's look at the story of Raj, a homeowner who took advantage of energy credits to save thousands. Raj wanted to reduce his carbon footprint and lower his utility bills, so he decided to install solar panels. The project cost $20,000, but thanks to the 30% residential clean energy credit, he was able to claim $6,000 on his tax return. This significantly reduced his out-of-pocket costs and made the investment more affordable. Over the next several years, Raj not only saved on taxes but also enjoyed dramatically lower energy bills, making the decision a win-win for both his finances and the environment. One of the most effective strategies for maximizing savings is stacking credits. This involves combining multiple credits to lower your tax bill even further. For example, you could claim the Child and Dependent Care Credit while also taking advantage of the Adoption Credit or the American Opportunity Credit for education expenses. The key is to ensure that you meet the eligibility requirements for each credit and keep detailed records to substantiate your claims. To illustrate the power of stacking credits, consider a family with 2 children. They claim the Child Tax Credit, which reduces their tax bill by $2,000 per child, and the American Opportunity Credit, which provides up to $2,500 for higher education expenses. If they also qualify for the Earned Income Tax Credit, their total savings could exceed $10,000 in a single year. By strategically combining these credits, the family significantly lowers their tax liability while supporting their financial goals. It's important to note that tax credits often come with specific requirements, such as income limits or documentation needs. Staying informed about eligibility criteria and changes to the tax code is essential. Working with a tax professional can help you identify credits you might otherwise overlook and ensure you're maximizing your savings within the bounds of the law. To make the most of tax credits, start by familiarizing yourself with the options available to you. In addition to the credits mentioned, there are incentives for adopting energy-efficient vehicles, installing electric vehicle charging stations, and making accessibility upgrades to your home. Researching these opportunities and planning your actions accordingly can lead to significant tax savings. Remember that timing plays a crucial role in optimizing credits. For example, if you plan to make a major purchase or investment that qualifies for a credit, consider doing so in a tax year where it will have the greatest impact. Additionally, some credits phase out at higher income levels, so understanding how your income affects eligibility is key. Tax credits are a cornerstone of effective tax planning. They provide an unparalleled opportunity to reduce your tax burden, support your financial goals, and align your actions with the incentives built into the tax system. By understanding how credits work, identifying the ones that apply to you, and leveraging strategies like stacking credits, you can unlock significant savings and take control of your financial future. Let's continue exploring how to harness the full potential of the tax system in the chapters ahead. Chapter 6. Business Owner's Edge: Leveraging the Tax Code. For business owners, the tax code offers a treasure trove of opportunities to reduce expenses, reinvest savings, and grow wealth. By understanding how to leverage tax benefits, entrepreneurs can optimize their earnings and keep more of their hard-earned money. Whether you're a sole proprietor, run a small business, or manage a growing enterprise, the key lies in structuring your business effectively and taking full advantage of write-offs. This chapter explores how incorporating your business can unlock tax benefits, explains the range of expenses you can deduct, and introduces the Expense Optimizer, a tool to ensure you maximize every opportunity. Choosing the right business structure is the first step in leveraging the tax code. Each structure, sole proprietorship, limited liability company, also known as LLC or S corporation, comes with distinct advantages and responsibilities. For sole proprietors, taxes are straightforward but can be limiting when it comes to deductions and liability protection. Incorporating as an LLC provides liability protection while offering flexibility in how income is taxed. You can choose to be taxed as a sole proprietor, partnership, or corporation, depending on what benefits you the most. S corporations go a step further, allowing business owners to split income between salary and dividends, potentially reducing self-employment taxes. For example, a sole proprietor earning $120,000 annually would pay self-employment taxes on the full amount. But by restructuring as an S corporation and taking $60,000 as salary while the rest is distributed as dividends, the owner could save significantly on taxes. These savings can then be reinvested into the business or used to build personal wealth. Choosing the right structure isn't a one-size-fits-all decision, so consulting a tax advisor can help you make the best choice for your situation. Writing off business expenses is another powerful way to reduce taxable income. The tax code allows business owners to deduct expenses that are ordinary and necessary for their operations. This includes everything from office supplies and marketing costs to travel and meals related to work. Let's break down some of the most valuable categories of deductions. Travel expenses can include airfare, lodging, transportation, and meals while conducting business away from home. If you combine business travel with personal travel, you can still deduct the business-related portion, provided you keep clear records. Home office deductions allow you to write off a portion of your rent or mortgage, utilities, and internet costs if you use a dedicated space for work. Vehicle expenses are also deductible if you use your car for business, whether you track actual costs or use the standard mileage rate. Let's consider the story of Emma, a small business owner who ran a graphic design studio from her home. Initially, Emma operated as a sole proprietor and wasn't maximizing her deductions. After attending a tax planning seminar, she restructured her business as an S corporation and began tracking every business-related expense meticulously. She wrote off her home office, upgraded her computer equipment, and even deducted her cell phone costs. By leveraging these deductions and optimizing her salary dividend split, Emma saved $20,000 annually. With these savings, she was able to hire an assistant, freeing up her time to focus on growing her client base. The key to maximizing deductions is consistency and organization, which is where the expense optimizer comes into play. This system is designed to help you identify and track every eligible deduction with ease. Start by maintaining a dedicated business account and credit card for all expenses. This separates personal and business spending, making it easier to track and substantiate deductions. Next, use expense tracking software to categorize costs in real time. Tools like QuickBooks or Wave are ideal for this purpose, as they integrate with bank accounts and generate reports that simplify tax filing. The expense optimizer also includes a checklist of commonly overlooked deductions. For example, you might forget that business meals, even those taken locally, can be partially deductible if they involve discussing work. Subscriptions to industry publications, software, and professional associations are also deductible, as are education expenses for courses or certifications that improve your skills. Staying compliant is crucial when claiming deductions. The IRS requires that all deductions be substantiated with records like receipts, invoices, or mileage logs. Regularly reviewing your records and reconciling them with your bank statements ensures that everything is accurate and up to date. If you're audited, having thorough documentation can save you from penalties and ensure you keep the deductions you've claimed. Another advantage of being a business owner is the ability to defer taxes through retirement contributions. Plans like Simplified Employee Pension IRAs, known as SEP IRAs, or Solo 401ks allow you to contribute a significant portion of your income tax deferred, reducing your taxable income for the year. This is an excellent way to save for retirement while lowering your tax bill. The tax code is designed to encourage entrepreneurship by providing incentives for business owners to reinvest in their operations and grow their ventures. By structuring your business effectively, tracking expenses consistently, and leveraging tools like the Expense Optimizer, you can take full advantage of these opportunities. Every dollar saved on taxes is a dollar that can be reinvested into your business or used to achieve your financial goals. Let's continue uncovering the strategies that make tax efficiency a cornerstone of wealth building in the chapters ahead. Chapter 7. Real Estate Tax Benefits. Real estate has long been one of the most powerful tools for building wealth, and a significant part of its appeal lies in the tax benefits it provides. From depreciation to mortgage interest deductions and tax-deferred exchanges, the tax code offers numerous incentives for property owners and investors. Whether you're a landlord, a homeowner, or someone exploring real estate investment trusts, also known as REITs, understanding these benefits can help you create a tax-efficient income stream and maximize your returns. This chapter will guide you through the key tax advantages of real estate, share the story of a landlord who transformed their finances, and introduce the real estate tax triangle, a framework for optimizing deductions, depreciation, and deferrals. Depreciation is one of the most valuable yet underappreciated tax benefits in real estate. Unlike most assets, which lose value as they age, real estate can be depreciated on paper even as it appreciates in market value. The tax code allows property owners to deduct a portion of the cost of their property each year as depreciation, offsetting rental income and reducing taxable earnings. For residential properties, the depreciation period is typically 27.5 years, while commercial properties are depreciated over 39 years. For example, if you own a rental property worth $275,000, you could deduct $10,000 annually in depreciation, lowering your tax liability significantly. Mortgage interest deductions are another key advantage for property owners. If you have a mortgage on a rental or investment property, you can deduct the interest paid on the loan. This deduction often represents a substantial savings, especially in the early years of a mortgage when interest payments are higher. Combined with property taxes and operating expenses, mortgage interest deductions can make owning real estate even more tax efficient. Tax-deferred exchanges, commonly known as 1031 exchanges, are a game changer for real estate investors looking to grow their portfolios. A 1031 exchange allows you to sell one investment property and reinvest the proceeds into another of equal or greater value without paying capital gains taxes at the time of the sale. This deferral means you can continue building wealth without the immediate tax burden, allowing your investments to compound more effectively. Let's consider the story of Victor, a landlord who used these strategies to turn a modest portfolio into a tax-efficient income stream. Victor started with a single rental property, generating $1,500 in monthly rent. By carefully tracking expenses and claiming depreciation, Victor was able to offset most of the rental income, significantly lowering his tax bill. As his equity in the property grew, he sold it through a 1031 exchange and upgraded to a multifamily property, increasing his rental income while deferring capital gains taxes. Over the next decade, Victor repeated this process multiple times, building a portfolio of properties that provided a steady, tax-efficient income. For those looking for a more passive way to invest in real estate, REITs offer an attractive option. REITs are companies that own, operate, or finance income-producing real estate, and they allow investors to earn returns without directly managing properties. REIT dividends are generally taxed as ordinary income, but their structure can still offer tax advantages, such as depreciation deductions at the corporate level that reduce the tax burden on distributions. REITs are an excellent choice for investors who want exposure to real estate without the responsibilities of property ownership. To optimize your real estate tax benefits, it's essential to understand and leverage the real estate tax triangle, which focuses on deductions, depreciation, and deferrals. The first side of the triangle is deductions, including mortgage interest, property taxes, repairs, maintenance, and property management fees. Keeping detailed records and separating personal and business expenses ensures you claim every eligible deduction. The second side is depreciation, which allows you to reduce taxable income without affecting cash flow. To maximize this benefit, consider working with a tax professional to explore options like cost segregation studies, which can accelerate depreciation on certain components of a property, such as appliances or landscaping. Accelerated depreciation can provide larger deductions up front, boosting cash flow in the early years of ownership. The final side of the triangle is deferrals, with the 1031 exchange as the centerpiece. By deferring taxes on capital gains, you can reinvest more of your profits into new properties, allowing your wealth to grow faster. The key to executing a successful 1031 exchange is careful planning and adherence to the rules, including identifying a replacement property within 45 days and completing the transaction within 180 days. It's important to remember that tax strategies must align with your overall investment goals. For example, while deferring taxes through a 1031 exchange is advantageous for growth, it may not be the best option if you need immediate liquidity. Similarly, REITs offer simplicity but lack the control and potential appreciation of direct property ownership. Real estate tax benefits are not just for seasoned investors, they're accessible to anyone willing to learn and apply these principles. By understanding deductions, leveraging depreciation, and exploring deferral strategies, you can turn real estate into a powerful tool for building tax-efficient wealth. The real estate tax triangle provides a clear framework for optimizing these benefits and ensuring your investments work harder for you. Let's continue exploring the secrets to saving thousands legally in the chapters ahead. Chapter 8. Investment Income and Tax Optimization. Investment income is a critical component of building wealth, but it also comes with tax implications that can erode your returns if not managed carefully. Whether you earn income through dividends, capital gains, or interest, understanding how these are taxed and implementing strategies to minimize your tax burden can make a significant difference. In this chapter, we'll explore how different types of investment income are taxed, introduce the concept of tax loss harvesting, and share actionable tips for optimizing your portfolio. You'll also hear the story of an investor who dramatically reduced their capital gains tax by reinvesting in municipal bonds and learn about the smart gains strategy, a powerful approach to timing your investments for tax efficiency. Dividends are a common source of income for investors and are typically categorized as qualified or ordinary. Qualified dividends are taxed at the lower long-term capital gains rate, while ordinary dividends are taxed as regular income. For example, if you're in the 15% tax bracket for capital gains, your qualified dividends are taxed at that rate instead of your higher income tax rate. This makes investing in companies that pay qualified dividends a tax-efficient way to generate income. Capital gains are another significant source of investment income. When you sell an asset for more than you paid for it, the profit is considered a capital gain. The tax rate on capital gains depends on how long you've held the asset. Gains from assets held for more than 1 year are taxed at the lower long-term capital gains rate, while those from assets held for a year or less are taxed at your regular income rate. This difference underscores the importance of holding investments for the long term to reduce tax liability. Tax loss harvesting is a strategy used by savvy investors to offset gains by selling investments that have lost value. For example, if you have a $5,000 gain from selling a stock and a $3,000 loss from selling another, the loss can offset the gain, reducing your taxable income to $2,000. If your losses exceed your gains, you can deduct up to $3,000 against your ordinary income and carry forward any remaining losses to future years. This strategy is particularly effective in volatile markets, where price fluctuations can create opportunities to harvest losses without significantly altering your portfolio. Tax-advantaged accounts like 401(k)s, IRAs, and health savings accounts are invaluable tools for optimizing investment income. These accounts allow your investments to grow tax-deferred or tax-free, depending on the account type. For instance, in a traditional IRA, you don't pay taxes on your contributions or earnings until you withdraw funds in retirement. In a Roth IRA, contributions are made with after-tax dollars, but withdrawals, including earnings, are entirely tax-free. Using these accounts to hold investments with high growth potential can amplify your returns while minimizing taxes. Let's look at the story of David, an investor who used municipal bonds to cut his capital gains tax and create a tax-efficient income stream. David had a portfolio of stocks that had appreciated significantly over the years. When he decided to sell some of his positions, he faced a substantial capital gains tax bill. To mitigate the impact, David reinvested a portion of his proceeds into municipal bonds. The interest earned on these bonds was exempt from federal taxes, and because David lived in the same state as the bonds were issued, he avoided state taxes as well. This strategy not only reduced his immediate tax burden but also provided him with a steady, tax-efficient income. Timing your investments strategically is another key component of tax optimization, which brings us to the smart gains strategy. This approach involves carefully planning when to sell investments to minimize tax exposure. For example, if you're approaching the end of the year and anticipate being in a lower tax bracket the following year, delaying the sale of a profitable asset could result in a lower tax rate. Similarly, by spreading the sale of investments over multiple years, you can avoid pushing yourself into a higher tax bracket. The smart gains strategy also considers the importance of rebalancing your portfolio without triggering unnecessary taxes. Instead of selling assets outright, you can redirect new contributions or dividends into underweighted asset classes, maintaining your desired allocation without realizing capital gains. Additionally, donating appreciated assets to charity allows you to avoid capital gains taxes while receiving a tax deduction for the fair market value of the donation. For investors seeking tax efficiency, understanding the role of municipal bonds, tax-advantaged accounts, and tax loss harvesting is essential. Municipal bonds are particularly appealing for high-income earners, as the tax savings can significantly boost after-tax returns. Similarly, placing high-dividend stocks or bonds in tax-advantaged accounts ensures that their income doesn't increase your taxable income. Portfolio diversification also plays a role in tax optimization. By spreading your investments across different asset classes and types of accounts, you can strategically manage when and how income is taxed. For example, holding international stocks in taxable accounts may allow you to claim a foreign tax credit for taxes paid to other countries, further reducing your tax liability. The tax implications of investment income can feel complex, but with the right strategies, you can turn them into opportunities. By leveraging long-term capital gains rates, utilizing tax-advantaged accounts, and implementing the smart gains strategy, you can keep more of your returns and accelerate your financial goals. Every decision, from timing the sale of an asset to choosing the right account for your investments, has the potential to make a meaningful impact. Let's continue exploring the secrets to saving thousands legally in the chapters ahead. Chapter 9. Tax Planning for Retirement. Tax planning doesn't stop when you retire, it becomes even more critical. Without a thoughtful approach, the money you've worked so hard to save could be eroded by unnecessary taxes. Retirement is a time to enjoy the fruits of your labor, but making the wrong decisions about when and how to withdraw your savings can leave you paying more than your fair share to the government. This chapter focuses on strategies to plan withdrawals, the benefits of Roth conversions, and managing required minimum distributions, also known as RMDs. You'll also learn about the Retirement Tax Map, a step-by-step guide to tax-efficient income planning. One of the most important aspects of retirement tax planning is understanding how withdrawals from various accounts are taxed. Traditional retirement accounts like 401(k)s and IRAs offer tax-deferred growth, meaning you don't pay taxes on contributions or earnings until you withdraw the funds. While this provides significant savings during your working years, withdrawals in retirement are taxed as ordinary income. By contrast, Roth accounts allow you to withdraw contributions and earnings tax-free, as long as you meet the requirements. Taxable brokerage accounts are another option, where only your capital gains are taxed, often at lower rates. Planning the timing and order of your withdrawals can make a significant difference in the taxes you pay. For example, in the early years of retirement, when you may have little or no taxable income, it's an excellent time to consider withdrawing from traditional accounts or converting them to a Roth account. Roth conversions involve moving money from a traditional IRA or 401(k) into a Roth IRA. While you'll pay taxes on the amount converted, Doing so when you're in a lower tax bracket can save you thousands over the long term. Let's consider the story of Jack and Diane, a couple who carefully timed their withdrawals to save on taxes. Jack and Diane retired at 62 with significant savings in a traditional 401k and a smaller Roth IRA. They decided to delay taking Social Security benefits until age 70 to maximize their monthly payments. During this gap period, they withdrew from their 401k just enough to stay within the 12% tax bracket and converted a portion to their Roth IRA each year. By the time they turned 70, they had reduced the size of their 401k, lowering the impact of their RMDs and creating a larger tax-free nest egg in their Roth IRA. Over the course of their retirement, this strategy saved them tens of thousands of dollars in taxes. RMDs are another critical factor to consider. Starting at age 73, the IRS requires you to withdraw a minimum amount annually from your traditional retirement accounts. These distributions are taxed as ordinary income, and failing to take them results in hefty penalties. Proper planning can help you manage the impact of RMDs. For instance, by converting funds to a Roth IRA earlier or withdrawing strategically in low-income years, you can reduce the balance of your traditional accounts and, in turn, lower the size of your required distributions. The Retirement Tax Map is a practical tool for tax-efficient income planning in retirement. It starts with assessing your income sources, such as Social Security, pensions, investment income, and withdrawals from retirement accounts. Next, prioritize withdrawals based on tax efficiency. For example, begin with taxable accounts, followed by traditional accounts, and save Roth accounts for last, as their tax-free status makes them ideal for future needs or as a legacy. Another layer of the retirement tax map involves managing Social Security benefits. Up to 85% of your benefits may be taxable if your combined income, defined as adjusted gross income plus non-taxable interest, and half your Social Security benefits, exceeds certain thresholds. By carefully planning other income sources, you can minimize the tax impact on your benefits. Charitable giving is another strategy to reduce taxes in retirement. Qualified charitable distributions, or QCDs, allow you to donate directly from your IRA to a qualified charity, satisfying your RMD requirement without increasing your taxable income. This is a win-win approach for those who want to give back while managing their tax liability. Diversifying your accounts before retirement is another key step in creating a tax-efficient plan. Having a mix of taxable, tax-deferred, and tax-free accounts provides flexibility and allows you to adapt your withdrawals to changes in the tax code, market conditions, or your personal financial needs. For example, during a year with high medical expenses, you might withdraw from a traditional account to take advantage of deductions, while in low-income years, you might prioritize Roth conversions. Finally, staying informed about changes to tax laws and RMD rules is crucial. Working with a financial advisor or tax professional can help you navigate these complexities and ensure that your plan remains effective over time. Tax planning for retirement is about more than just saving money. It's about maximizing the resources you have to create a secure and enjoyable future. By understanding the tax implications of withdrawals, leveraging Roth conversions, and managing RMDs effectively, you can keep more of your savings and achieve greater financial freedom. The Retirement Tax Map provides a clear guide to making these decisions with confidence, ensuring your golden years are truly golden. Let's continue exploring more strategies to save thousands legally in the chapters ahead. Chapter 10. Tax Strategies for High Earners. For high earners, the stakes are higher when it comes to taxes. The more you earn, the more creative and strategic you need to be to minimize your tax burden legally. Advanced strategies, such as donor-advised funds, deferred compensation plans, and charitable giving through trusts, offer powerful ways to reduce taxes while aligning with your financial goals. This chapter will delve into these techniques, share the story of a tech executive who used a donor-advised fund to save thousands, and introduce the Wealth Shield, a comprehensive approach to protecting and growing wealth through tax strategies. Donor-advised funds, also known as DAFs, are a favorite tool among high earners for maximizing tax efficiency while giving back to causes they care about. A DAF allows you to contribute cash, stocks, or other assets and receive an immediate tax deduction for the full value of your donation. The funds can then be distributed to charities over time, giving you flexibility in your philanthropic efforts. Additionally, appreciated assets donated to a DAF avoid capital gains taxes, increasing the impact of your gift while reducing your tax liability. Deferred compensation plans are another key strategy for high-income earners, especially those in executive positions. These plans allow you to defer a portion of your salary or bonuses to a future date, such as retirement, when your tax rate may be lower. By deferring income, you reduce your taxable income in the present, potentially saving tens of thousands of dollars annually. Deferred compensation plans also provide an opportunity to grow your deferred earnings tax deferred until withdrawal, compounding the benefits. Charitable giving is a cornerstone of tax planning for high earners, and trusts can enhance its effectiveness. Charitable remainder trusts and charitable-led trusts are two popular options. A charitable remainder trust allows you to place assets into the trust, receive income from it during your lifetime, and donate the remaining assets to charity upon your death. This strategy provides an immediate tax deduction, reduces estate taxes, and creates a meaningful legacy. A charitable lead trust, on the other hand, pays income to a charity for a set period before passing the remaining assets to your beneficiaries, often with reduced gift or estate taxes. Let's look at the story of Amanda, a tech executive earning a seven-figure salary who used a donor-advised fund to optimize her taxes and support causes she cared about. Amanda had significant stock options from her company, which had appreciated dramatically in value. By donating a portion of these stocks to a DAF, she avoided paying capital gains taxes on the appreciation and received a substantial tax deduction for the full market value of the donation. Over the next several years, Amanda distributed the funds to various charities, supporting education and environmental initiatives while enjoying the financial benefits of her strategy. The Wealth Shield is a blueprint designed to combine multiple tax strategies into a cohesive plan for protecting and growing wealth. It starts with structuring your income to minimize taxes. For example, high earners often have a mix of salary, bonuses, and investment income. By deferring income through compensation plans or investing in tax-efficient vehicles like municipal bonds, you can lower your taxable income and reduce your overall tax burden. The second component of the Wealth Shield is leveraging tax-advantaged accounts. For high earners, maximizing contributions to 401ks, health savings accounts, and backdoor Roth IRAs can shelter significant income from taxes. A backdoor Roth IRA is particularly valuable for those who exceed income limits for direct Roth contributions. By contributing to a traditional IRA and converting it to a Roth IRA, you can enjoy tax-free growth and withdrawals in retirement. The third component is estate planning. High earners with substantial assets need to consider how their wealth will be taxed upon transfer to their heirs. Trusts, such as irrevocable life insurance trusts, can remove assets from your taxable estate while providing financial security for your beneficiaries. Lifetime gifting strategies also allow you to transfer wealth tax efficiently, taking advantage of annual gift tax exclusions and lifetime exemptions. Timing is another critical element of the Wealth Shield. By strategically timing income, deductions, and investments, you can further optimize your tax outcomes. For instance, bunching deductions by making multiple years' worth of charitable contributions in a single year can push you into a higher deduction threshold, maximizing your tax savings. Similarly, selling investments during a year when your income is lower can reduce the impact of capital gains taxes. Staying compliant is essential when implementing these advanced strategies. High earners are often subject to increased scrutiny from the IRS, so working with experienced financial advisors and tax professionals is crucial to ensure your strategies are executed correctly and within the bounds of the law. For high earners, taxes can feel like an unavoidable burden, but with the right approach, they become an opportunity to protect and grow wealth. By leveraging tools like donor-advised funds, deferred compensation plans, and trusts, you can align your tax strategy with your financial goals and give back to causes that matter to you. The Wealth Shield brings these strategies together, creating a comprehensive plan that not only reduces taxes but also enhances your ability to build and preserve wealth. Let's continue exploring how to unlock the full potential of the tax code in the chapters ahead. Chapter 11. Staying compliant while saving big. When it comes to saving on taxes, compliance is not just important, it's non-negotiable. The tax code offers countless opportunities to reduce your liability, but these strategies must be implemented within the rules. The last thing anyone wants is to face an audit, penalties, or legal troubles because of mistakes or missteps. Staying compliant ensures your savings are legitimate and sustainable, allowing you to focus on building wealth with peace of mind. This chapter will explore the importance of legal compliance, the value of professional guidance, and practical steps to safeguard yourself with the Tax Audit Toolkit. Compliance starts with understanding the boundaries of the tax code and staying within them. The government encourages taxpayers to take advantage of deductions, credits, and other incentives, but these must be applied accurately. Misreporting income, claiming ineligible deductions, or failing to keep proper documentation can trigger audits and lead to penalties. Staying organized and informed is your first line of defense. Consulting with tax professionals is one of the smartest moves you can make. Certified public accountants, also known as CPAs, and enrolled agents have a deep understanding of tax laws and can help you navigate complex situations. They ensure you're maximizing your savings without crossing into gray areas. Additionally, they stay updated on changes to the tax code, which can be critical for high earners, business owners, and investors. Tax laws evolve frequently, and failing to adapt can result in missed opportunities or unintentional errors. Consider the story of Lisa, a self-employed graphic designer who ran into trouble when filing her own taxes. Lisa was diligent about tracking expenses and claiming deductions but overlooked a critical rule about home office deductions. She included part of her living room as a business expense, which was flagged during an audit because it wasn't exclusively used for work. After receiving a notice from the IRS, Lisa decided to hire a CPA to help her address the issue. The CPA not only resolved the audit but also identified additional deductions Lisa had missed in prior years, ultimately saving her thousands. This experience taught Lisa the value of professional guidance and the importance of adhering strictly to the rules. To safeguard yourself against audits and ensure compliance, it's essential to implement a system like the Tax Audit Toolkit. This step-by-step guide helps you prepare for the possibility of an audit while maintaining accurate records throughout the year. Start by keeping all tax-related documents organized and easily accessible. This includes receipts, invoices, bank statements, and records of charitable contributions. Digital tools like QuickBooks or Expensify can help you categorize and store these documents efficiently. Another key component of the Tax Audit Toolkit is maintaining a calendar of significant financial events, such as property purchases, stock sales, or major business expenses. Documenting these events in real time ensures you have the context and details readily available if questioned. For example, if you claim a deduction for a business trip, keeping records of travel itineraries, meeting notes, and receipts will substantiate your claim. Filing accurate returns is another critical aspect of staying compliant. Double-check all entries for errors, especially when reporting income, social security numbers, and deductions. Simple mistakes can raise red flags and delay the processing of your return. If you're using tax software, ensure it's updated with the latest tax laws. If your situation is complex, working with a professional can provide an additional layer of assurance. Finally, be proactive about staying informed. The tax landscape changes regularly, with new deductions, credits, and regulations introduced each year. Subscribing to updates from trusted sources or attending tax planning seminars can keep you ahead of the curve. Professionals like CPAs often offer consultations or newsletters to help clients navigate these changes effectively. Audits, while intimidating, are not as common as many fear. However, certain factors can increase your likelihood of being audited, such as large deductions relative to your income, significant changes in income, or claiming credits you don't qualify for. The Tax Audit Toolkit equips you to handle an audit with confidence, ensuring that your documentation and filing process are airtight. Staying compliant while saving big is about finding balance. The tax code rewards those who use its incentives wisely, but it also demands accuracy and transparency. By working with professionals, keeping detailed records, and staying informed, you can confidently reduce your tax burden without stepping outside the lines. The Tax Audit Toolkit ensures you're always prepared, allowing you to focus on growing your wealth and achieving your financial goals. Let's move forward with the confidence that every dollar saved is a dollar earned, and every action taken is one that respects the rules. As we come to the end of this audiobook, let's take a moment to reflect on what we've explored. Throughout this audiobook, you've learned powerful strategies to reduce your tax burden, keep more of your income, and use the tax code to your advantage, all while staying fully compliant with the law. These are the same techniques that the wealthy use every year to protect and grow their wealth, and now, they're tools you can use to transform your own financial future. We began by understanding the mindset shift required to see taxes not as an unavoidable burden but as an opportunity. By learning how the wealthy view taxes as a controllable expense, you've started to see how strategic planning can make all the difference. From mastering the basics of the tax system to uncovering hidden deductions and credits, each chapter has given you actionable steps to unlock savings and redirect those dollars toward what truly matters to you. You've discovered the incredible power of tax-advantaged accounts like 401ks, IRAs, and health savings accounts, which provide opportunities to save for the future while reducing your taxable income today. We explored the benefits of leveraging real estate tax strategies, maximizing deductions for business owners, and optimizing investment income through techniques like tax loss harvesting and strategic timing. Each of these tools equips you to not only save but to grow your wealth in the most efficient way possible. One of the most inspiring lessons came from the stories of individuals who embraced these strategies and saw life-changing results. From a self-employed professional who saved thousands with the help of a CPA to a landlord who built a tax-efficient income stream through real estate, these examples prove that these techniques are accessible to anyone willing to learn and take action. We also dove into advanced strategies for high earners, including donor-advised funds, deferred compensation plans, and charitable trusts. These tools highlight the importance of aligning your financial goals with your tax strategy, creating a plan that not only reduces taxes but also supports the causes and legacies you care about most. And for those approaching or already in retirement, we explored the importance of tax-efficient income planning, ensuring your savings last as long as you need them to. Of course, none of these strategies would be complete without a commitment to compliance. Staying within the rules is not just a requirement, it's the foundation of sustainable tax savings. With the Tax Audit Toolkit and the guidance of trusted professionals, you're prepared to navigate the complexities of the tax code with confidence, knowing that your approach is both ethical and effective. Now, as you move forward, remember that tax savings are not just about dollars, they're about choices. Every dollar you save on taxes is a dollar you can invest in your future, your family, your passions, or your community. It's about taking control of your financial situation and using the tools at your disposal to build the life you envision. This journey is not just for the wealthy, it's for anyone ready to take action. Whether you're just starting to explore these concepts or you're looking to refine an existing strategy, the key is to begin. Commit to learning, planning, and taking the steps necessary to optimize your taxes and build your wealth. The strategies you've learned here are a foundation, and as you continue to educate yourself, you'll discover even more opportunities to enhance your financial well-being. So here's your call to action. Start saving thousands legally. Your journey begins today. The path to financial empowerment is in your hands. With knowledge, strategy, and determination, you can take control of your taxes and your future. Thank you for listening. If you found this audiobook valuable, please hit the like button and subscribe to my channel for more content like this. Be sure to check the video description for tools and resources that can help you take your wealth journey to the next level. See you on the next one.